Well, good afternoon. I'm Ed Parrott with Keller Williams Realty, and I'm here with Lisa Stepp with MPire Financial. And this afternoon, we are going to take time to discuss mortgage options for the first-time home buyer. Now, the interesting thing about it is, of course, first-time home buyers, it's always an exciting time, and they're generally quite happy to be in their new home. But there's a process to go through, and the first thing really that you should do is put your application in with the finance company to get your mortgage pre-approved and or pre-qualified, I guess. As Lisa and I were discussing earlier this morning, we have different terms. She's a mortgage professional, and I'm a realtor, of course. And I was talking about a little bit of realtor language with her, and I'm sure she will probably correct me when I say get pre-approved, because I'm thinking it's probably pre-qualified, isn't it, Lisa?
Well, we actually like pre-approval, and that pre-approval states that we've seen all the assets, income, and it would like we're ready to go into underwriting for our official mortgage commitment. Pre-qual is just, taking the word of the borrower, potential borrower, and sometimes it can be way off, especially if
So
they're self-employed. So we only do pre-approvals because if we're going to send somebody out with you, Ed, to go find their new home, we absolutely want to make sure that they're qualified to buy that home.
So the
So
pre-approve or pre-qual is kind of
pre-approval,
like the old quote no doc they used to do.
yeah, it can
Oh,
be because, nobody, sends anything in. So, and sometimes it can be way off. Especially if we're dealing with like a retired person, and there's so many different income streams. And there's different guidelines according to what that mortgage income that we're going to use, how we have to equate it. So if you receive any kind of disability payments, then we get to actually gross that up. So you actually receive more credits for that income than maybe just what's documented on paper. So that's why
mhm.
you really need to deal with someone that's, been in mortgage for a while. So they have a full understanding of all the different income sources and how you use them. And then, depending on income, sometimes that will actually direct us to what kind of mortgage we're going to do as well.
Okay, and today, of course, we're talking about first-time home buyers. So for I thought it was interesting here, this little chart I pulled up on first-time home buyers as a percentage of all the sales. And as you can see, it's bounced around over the past 3 years or so, but it's been hanging right around 28 to 30%, and currently is running about 31% of all buyers are in fact first-time borrowers. So, on the subject then of first time borrowers, there are several different mortgage types, as I understand it.
Mhm.
So, why don't we take a look at those, and you can tell me which would be the best for what kind of a loan to get for the first time borrower, depending on their circumstances.
Well, there's typically two types. You've got conventional financing, and that is like what we call Fannie and Freddie, where if you don't put 20% down, you have to pay private mortgage insurance. And then there's the whole onslaught of government loans. That's your FHA, VA, USDA, and those come with FHA's 3.5% down. But the conventional arena also has programs for the first time home buyer with maybe 3% down. And what's big right now is depending on if you want to go conventional or government, a lot of those companies are offering down payment assistance. And that can come in the form of, hey, they're like one company, their program is say, we're going to give you a grant for your 3.5% down. And if you stay in that home for 5 years, you don't even pay it back. We're just going to give you that money for your down payment. You cover your closing cost, and or maybe we use seller credits to cover closing costs. So technically, you could get into a new home without any money down. So it just depends on their credit score, their income, what the price point is on the home. And typically around the 240, 270 mark, it is usually what the price point is of the loan amount to determine what's cheaper for them. Is government financing cheaper or is conventional financing cheaper? So
Okay.
until all like that income, credit score, the loan application is complete, that's when, once we see all the information, we determine in having conversation with the borrower, what's important to them, what's their long-term goals. Is this like their forever home, or, hey, they're just relocated here, they're going to be here for 3 years, and they know typically they'll be, gone to another location. So all that kind of matters. It's not just about the process right at this moment, but where the potential borrowers are going to be 3, 5, 10 years down the road as well. Will help determine what mortgage product we want to choose for them and what fits their scenario the best.
Okay. You mentioned credit score, of course, and obviously that's highly important. And most first-time buyers are going to be in the younger category typically, although an older person could be a first-time buyer. And of course, actually, a first-time buyer, as I understand it, is somebody who has not owned a home within the last 5 years. Is that
3 years.
correct?
3
3
years.
years. Okay.
3 years.
So,
No mortgage
yeah.
on their credit in the last 3. And then, and as long as it hasn't been there and they've owned previously, it doesn't matter. We still get to classify them as a first-time home buyer.
Okay, so I kind of misspoke there when I said
Yeah.
typically they would be younger, because certainly there could be older people that
Mhm.
have either paid off a mortgage over 3 years ago or sold a house and haven't owned, or maybe they rented temporarily, whatever. So they would
Or a
qualify as
lot of
first
them have been
time.
on the road with COVID, bought their motor home and has been traveling the country, and now they want to come back and be closer to their kids. Now they're looking at a small house and bring them off the road.
Okay, well that's logical. So on the subject then of credit scores, I guess we'll primarily think of the younger folks because they may be less experienced in managing their credit score. Obviously, such things as making all your payments on time are important, but a lot of people don't understand that carrying a large balance on credit cards uh, compared to the limit on the credit card is going to hurt your credit score. So typically, what is it like? They want to see less than 20% balance versus the.
It depends on who they talk to. So typically, in order to achieve a higher credit score, and when you're dealing with mortgage versus just going and buying a car, there's 3 credit bureaus: Equifax, Experian, and TransUnion. And if you have a car loan, depending on who's the financing person or the company, depends on who they report that loan and those payments to. So, because not every creditor will report that you have a loan or a credit card to all 3 bureaus. So there are different, oh my gosh, the word is just slipping my mind at the moment. But if you're going to go apply for a mortgage, that when the 3 bureaus is pulled, it's going to have a different logarithm than as if you're going to go buy a car, or if you're going to buy a credit, or if you're applying for a credit for like a credit card, department store, Visa, MasterCard, American Express, whatever. They're all different. So when, I love looking at Credit Karma. They'll say, hey, I got an 800 credit score. And we'll pull the credit for mortgage. Oh, well, you're down to a 740. And they get so upset with that. Because they're different logarithms in that, based on whatever kind of financing you're going after. Mortgage is definitely a little bit more in depth. And if you're buying a house and a car at the same time, typically that car FICO score will be higher than the mortgage, just because of the logarithms and what it's doing to generate that score. So the higher the score, the less risk there is to the bank, if you will. Therefore, you get better pricing, better rates, etc. So if you have, and we have programs that'll go all the way down to a 500 credit score, that generates a lot of risk. So
I'm
if you
shocked
have
that they
a
go down to
500
500.
credit score, now that rate could be over 10%. So
Okay.
and there's banks out there that you can be one day out of bankruptcy, one day out of foreclosure, and they'll turn around, they'll give you another mortgage with certain criteria. But again, it's all about risk. So, if rates are 7.5% today, you are not going to get that rate. You're going to come with risk, and it's going to be a lot higher.
Mm-hmm. Now, another point I wanted to touch on for the credit scores is the fact that most people don't realize that just before closing on the purchase, the mortgage company is going to pull credit again, and they don't want to see any additional purchases on there. So do not go out and buy a car or even furniture, whatever,
Right.
Wait until after the house is
Wait until
closed.
after you've signed your documents and your loan has funded.
Yes, so that
And
has killed a number of
a lot of deals.
yeah.
Absolutely.
So
Yes.
fortunately,
And,
I've never been involved in one of those, but I've certainly known people that have been involved in them.
and
So
don't quit your job in the middle and don't get
yeah.
fired, because in addition to a soft pull going into closing, they're doing a last minute verification of employment. Are you still employed?
Mm-hmm.
So
Okay.
hopefully there's no layoffs. So, and you get to proceed to closing.
Mm-hmm. Now, for the veterans, of course, there's the VA loan option
Absolutely.
available, and would that have any advantage for a first-time buyer opposed to a conventional or?
If you are a veteran, yes, absolutely. You can do 100% financing with no private mortgage insurance. And so we do, when you are a veteran, I'm working with one right now. He's a National Guard. He's been 2 deployments for more than 90 days. And we're trying to get his DD 214 so we can actually go get a certificate of eligibility. For VA financing, the first thing we pull, and we can help with that, is the certificate of eligibility. So we know exactly what their entitlement is. And based on their entitlement, like FHA financing, there is a funding fee. If you're a disabled veteran, you don't pay a funding fee. And there's different criteria, depends on what that funding fee is.
Mhm. On the very first usage of a VA loan, is there a funding fee on that as well? It just goes
Can
up
be.
with subsequent?
Yes.
Okay.
Yes.
So I
And it
wasn't real
depends
clear.
on
I was,
the situation. So we just log in and say, okay, here's his eligibility. Has he used it before? I got a disabled veteran now. They're selling one home in a different state, moving to Tennessee, and that eligibility will be funded again. And we proceed on the new home in Tennessee, VA financing, and he's disabled, so he doesn't pay a funding fee.
Mhm.
It just gets
Okay.
financed right in. The funding fees get financed right into the loan.
Right. Yeah, for some reason I was thinking the very first time they got a VA loan, there wasn't a funding fee. So I'm glad you
Mhm.
cleared that up for me
Yeah.
and everybody else. Um, on the USDA loan, you mentioned there's typically a 3.5% or 3% down payment. Which one were you saying?
USDA can be 100% financing, and it's based on the property address. So the
Hmm.
property itself must qualify for USDA. You can't buy something in the city and have a USDA loan. It's mostly rural.
Hmm.
And there's a lot of USDA eligibility here in surrounding Knoxville.
Hmm. So like up in Newmarket, places like that.
Yep.
Okay. Um, are they doing adjustable rate mortgages anymore? Are those
There
still a
are
thing?
arms that are available, and that's typically, and sometimes the arm pricing is not beneficial, and just it could be the same rate as your conventional or government financing. So some people, typically if it's a very large purchase, and depending on all of their financial picture, they may want an arm. Typically, recently we've seen some really high-end homes, more than $1 million mortgages, may want to look at an arm. 3, 5, 7, 10 years, depends on like the different banks that we deal with. And because some people have very specific reasons as to why they want that arm. A lot of people, if they're upper management in a company, typically will relocate every 3 to 5 years. They don't want a 30-year mortgage. Okay, the last 20 years I've only held a mortgage for 3 years. Just give me a 3-1 arm. If it's cheaper for them.
Yeah. Typically, are they cheaper for the first 3 years?
Typically they are, but just depends on current economic data. I haven't looked at ARM pricing over the last couple of weeks, and today's been a really wild day out there in the economy. Rates came out really good this morning, and they took all those gains back this afternoon.
Ah, okay.
Yeah.
Well, I was planning on getting to interest rates a little later, but let's just go ahead and pop it up here. This was yesterday, what I saw, and that was 7.06%. Of course, that's an average 30-year fix
It's an
for
average,
the
right?
whole ball of wax. So
That's
what are you
correct.
seeing as kind of an average today?
Depending on, that could be great. But what they don't tell you when if you like, you can Google anything and find anything you like. Oh, here's a 7% rate. But, some banks, when they advertise their mortgage rate, it's 20% down. It's 740 FICO scores and above. So if you're a 620, 640 credit score, you are not necessarily going to see those advertised rates out there in the marketplace. So that rate brings in what is your FICO score, what is your down payment, to determine what eligibility for that rate. Because everything in mortgage is based on risk. The lower the FICO score, the higher the rate. And then you can talk about secondary markets, and that can be a whole other hour discussion. And because things change all the time, you may have one bank that'll offer 6.5, but because they're trying to fill a pool of something. So it's not unusual to have somebody come out and say, hey, here's my 6.5 today, and you better grab it if that's the case, because they may be trying to fill a pool of mortgage-backed securities. They need another $1 million so they can send it off to that bond. That is it. Secondary market is wild, but that's really what controls our rates. And you almost need to be an economic professional always to determine what's going on out there.
Now, you mentioned earlier today that the rates had gone down considerably, but it's gone back up in the afternoon. How low did it get this morning?
And market's still a little unshaky. I'm not sure what's driving it today, because we opened up really good. And it's not unusual. They'll start, we'll go up to 430. And if there's deterioration in the market, they'll increase them again. So you just never know. So, one of the big things that first-time home buyers are very adamant about is their payment. So, and rate dictates what that payment is. But if you focus on the payment, then you're not really worried about the rate, because it's about the affordability, right? So, first-time home buyer, now they're going to have a mortgage payment. Now all the utilities are coming in. Maybe they've been in a rental situation and everything's been included, or they buy and they're in HOA. Now they got to pay $140 a month, and HOA fees. It's just whatever, first-time home buyers are definitely more payment sensitive. And like, hey, I don't want to exceed an $1,800 payment, or whatever that number may be. And then that'll dictate sales price, potentially mortgage type, what's their down payment, etc. Because they seem to be more sensitive to that payment.
But of course, the payment is going to be sensitive to the interest rate as well. So
be sensitive to the interest rate. Yeah. Now, so, and some people, if they have a lower score, means that, they really want to go after a $300,000 home. Maybe they're actually capped at 250. All those moving parts are always constantly being juggled by purchase price, down payment, what's the rate today, especially if they're kind of like on the cusp of approval. Different programs require different debt ratios. So you need to be a mortgage professional absolutely knows that and communicates that potentially to their borrower. They should. Just so they know, hey, here is your pre-approval. We've got a lot of room, or we don't have a lot of room. And typically we like to go, is, hey, here's what you want for your approval, because here's your payment that you like. However, you do have room to go up if you can't find a home in this price range. Just so we cover all of our bases with our folks out there and our realtor partners to make sure that, they're looking at the appropriate house for that buyer. And did I lose?
No, I'm still here, but my camera died on me. So that's one of the joys of live streaming, huh?
Oh, absolutely. Yeah.
Let me see if I can get this thing working with a different camera. Well, it doesn't seem to want to pick up my other camera either. So that's lovely.
Well, at least we can still hear you, so that's a plus. And I think we lost Ed, so just going to wait for him to pop back in here. And hopefully his camera will be working. There he is.
Well, apparently, when I tried to change cameras, it turned the audio off as well.
Oh, okay.
So that's not good. But well, okay.
All
So
right.
I'll just ask my question, and I'll be a little vibrating voice over there.
Okay.
So on my question was, and apparently my microphone was out at the same time. In terms of locking in a rate, like on a day like today, you wouldn't necessarily know to lock in a rate early in the morning. So how do you time locking in a rate for somebody?
It really kind of depends on the borrower. Most of us mortgage professionals, like I've been in the industry for just about 23 years. I pay for a service that monitors, there you go, your camera's working, monitors what's going on. Today I did receive a phone call. It was a lock alert. So some people, when they do their application, they're under contract. We have a closing date. We know that this mortgage is going to go. They may just say, you know what, lock me. And then some people are like, no, because there's different rate lock structures. Maybe are closing 60 days out, 45 days out, 30, 15. I submitted a loan and we were clear to close in 6 days. So I don't really need to take a 30-day lock at that point. I could take a 15-day lock. And the smaller the lock window, the cheaper the rate is. So it just really depends on the borrower. A few weeks ago on Wednesday, there was a lot of big economic news that was due out. Feds were going to make a statement, and the market was just a little shaky. They kind of expected what was going to happen. So my people that were floating and had not locked their rate, I made a phone call and I said, look, tomorrow's big economic news. Rates can go up, they can go down. My crystal ball has been broke for years. So what do you want to do? Like, here's your rate right now, and this is what we can lock in. Or do you want to risk it? And interest rates can move a quarter or a half a point. And depending on your loan amount, that could be an additional $20 to $60, depending on your loan size, moving an eighth or a quarter, it can be substantial in terms of increased payment. So it's whatever that borrower is comfortable with. But once we lock, there's no undoing that lock.
Okay, well, that was my next question.
Yeah.
Basically, two questions. Is there a fee for locking?
No fee
And
to lock. No fee to
okay,
lock. And there
but
are
the second
rare
question was,
occasions to say, and I've seen it a few times throughout my tenure as a mortgage broker. Like say interest rates are 7%. And typically, if there's something going on in the international world that will have a big impact on US markets, and interest rates are just falling, no bank wants their whole entire pipeline to pull out. So there's been occasions where we've had the opportunity to do a float down and take the lower
okay,
rate because market has dictated that. We've got all these loans and mortgages ready to close, but maybe our interest rates are now half a point lower. The bank doesn't want to lose that, so they'll give us some options for our borrowers. And that has
okay,
happened.
that was in fact my next question. If there was any way to follow it if the rate
There's some
goes
rules
down.
and guidelines that rates have to move a certain percentage. Every bank is a little different. So we just have to really kind of look at, and I've not seen that for a very long time.
Hmm.
Will we ever go back to the 3% mortgages? I don't believe so.
Hmm. Probably not. Certainly not anytime soon.
Yeah.
But earlier you were talking about private mortgage insurance. So that, as I understand it, does not apply if your down payment is more or 20% or more.
That is
But
correct.
if it's less than that, how does the PMI affect the payments on the loan? Does it increase the smaller the down payment? Like if you put 15% down, is the PMI less than
And
10%
it's
down?
all relative to FICO score, down payment. It'll generate factors for us. And I've got one lender right now that, and I don't remember even like, there's been so many changes in the PMI world. I don't even know who's left in terms of companies. But I've got one big lender that I like a lot, and their PMI factors are the cheapest I've ever seen. So if I know we're going to do and PMI, VA loans don't have it.
Mhm.
So, not every loan, you're not going to be required to pay PMI because banks can come out with a certain portfolio program and no PMI would be allowed. And there's lots of new programs out there with the 100% financing for first-time home buyers, and it will not come with PMI. So banks can just create whatever they want and not necessarily have the PMI. But typically your PMI would increase, that payment, would increase with a smaller down payment in the conventional arena.
Mhm. Okay. Well, what advice do you have to close out here for first-time buyers?
Well, and it's not just first-time home buyers, but when you're dealing with the financial aspect of obtaining your mortgage, make sure you choose someone that is knowledgeable, has a team, and communicates well. I was so disappointed when I got a fairly large loan that someone approved, didn't know what they were doing. They're still under contract, but we had to rewrite the contract a little bit. There was no way, and that's the difference between pre-qual and pre-approval. These people have the loan officer just didn't do it correctly, gave them a false pre-approval, and then just wouldn't communicate. And it cost the borrowers 3 weeks of time only to receive a denial letter, which can be mortifying. And that was all chalked up to a loan officer writing a VA loan that didn't understand a VA loan and
You
understanding
have,
entitlement.
have you had a number of instances where you've had to pick up a mortgage that somebody else started, some other company, and they screwed it up?
I have.
Mm.
And those borrowers are challenging sometimes because I have a mortgage. I apply for credit. It is a little scary. I don't give anyone false hope. Hey, maybe we cannot do the approval today. However, if you do X, Y, and Z, we can absolutely give you an approval. If they're a 600 FICO score borrower, we have programs that'll say, you know what, if you can pay down this credit card, we can get up to a 620. That'll give you a better rate, or up to another bucket for pricing to get them a better rate. And we do that. I've got people right now that I'm helping, and they're almost ready to go shop for their home. It's not always just one and done. There are things out there. Is something on their credit inaccurate? Do we need to get it removed? Do we need to and if you're ever going to go after a mortgage, do not dispute everything on your credit report, because that creates a little bit of a nightmare. Because each program has different requirements. So, but dealing with, someone that's been in business for a long time, a reputable company. I'm a mortgage broker. I did not want to be an independent mortgage bank. I did not want to work for one entity to put all my eggs in one basket. I have 85 different lenders I get to work with. Who's got the best VA construction loan? I've got a company in Jersey I'm working with. Who's my best, whatever. Each transaction is a little different. And to me, it's like, when the process starts, like a puzzle piece, and you got to fit all those puzzle pieces together, which can be really quick. And sometimes I'll pick a lender depending on the circumstances. Hey, I know we're going to maybe need a really fast close. This mortgage is going to have to go really super fast. So here's my lender that has the best. I can get it done in 5 days if I have to. And those kind of things. So it depends on each individual circumstances. Everything is just not cookie cutter.
One little final note I would add in here is you're talking about dealing with somebody that's knowledgeable. I highly recommend that people seek a local mortgage broker, be it you or somebody else. These internet mortgages, I don't like them. And every time I've had trouble with a deal, it's been an internet mortgage. So if you want to save yourself some headache, if you're getting a mortgage, work with a local professional that knows what they're doing. And there are a number of them out there. Certainly you're one of them. And I know a couple more. So, and I'm not allowed to steer a client to one particular agency, but I give 3 names. And then the consumer has to do a little research on their own and call up everybody and see who they like best. Same with like a home inspector. I give them 3 home inspectors, and then they have to call up and talk to the home inspecting company and see which one they get a good feeling about. So that's my big deal. Get somebody local. Don't go internet.
And great communicator. And for me, I've got a team. So if I'm not available, one of my teammates is available. So, and what's great for me is they work Mountain Standard Time. So I start the morning, but I get to be done working, but I know they're still working 2 more hours. So, Friday at 5 o'clock, man, okay, they're going to work till 7. And if something needs to happen in the evening, we get it done.
Yeah.
And there's some benefit to that as well.
Okay. Well, Lisa, it's been good talking with you again today.
Absolutely.
And
I appreciate
it's
you.
always good information. So I will let you go. I'm sure you got stuff to do. And I got a thing or two to do too. So including the dog down here standing up on my leg wanting to go out. So what can you do? But he's a good little guy.
He is.
So thanks a lot. And we'll talk with you later.
Okay. Thanks, Ed. All right. Bye-bye.